Hi, welcome to Main Street Macro. I'm Neela Richardson. A couple of weeks ago, Federal Reserve Chair Jay Powell said that the labor market was tight to the point of being unhealthy. And though we at the Main Street Macro recognize that there's been a tremendous amount of progress in the jobs market since the blow of the early pandemic, there is still a recurrent theme that labor shortages have been persistent. So in today's blog, we look into giving the jobs market a health check to see if it's really as healthy as we all hope it is. Now, the first place to check is the quits rate. Yes, the great resignation, because the actual event of quitting a job is a signal of a healthy economy. That's when the quits rate is lower than the hiring rate. What that suggests, and that's what's happening now, is that yes, people are still quitting at elevated levels, but they're not leaving the labor market entirely and they're actually finding new jobs. Now, where it becomes a bit unhealthy is that the job openings rate, the fact that there is so much demand for headcount right now from companies of all sizes, that rate is really, really high. It's well above the hiring rate. So, for the recovery to continue to make progress and improve, what we'd like to see is that the number of job openings and the number of hirings become closer together. So, on this metric, we give the economy a healthy, but we're watching to make sure that there's steady improvement towards more hiring in the future. Now, the second place we're looking to make a measurement in terms of health is the overall recovery of jobs in different sectors. And here we're seeing somewhat of a mixed result. There are some sectors where the employment rate is actually higher than it was before the pandemic. Those include professional business services, warehousing jobs, transportation jobs, and retail jobs, thanks to all that glorious consumer spending that has been resilient through the recovery period. It also points to how the economy has been restructuring, pointing to more e commerce activity, which has supported warehousing jobs. But there are some industries that haven't benefited from the pandemic economy. And those industries are in those consumer facing industries that still have some lost ground to make up. So, here, when it comes to the health check, we're going to give it a neutral. And then the final place that we're looking to make a measurement is in wages. Wages are a very important part of a dynamic economy. But if wages are growing too fast, meaning they're outpacing productivity changes, then that means that wages have the characteristic that they could add to inflation. And we all already know that inflation is at a 40-year high. So right now, wages still are lower than inflation. They don't seem to be meaningfully contributing to the high pace of inflation, but it's definitely something that we'll continue to monitor over the course of the year. We've come a long way in the jobs recovery, but it's clear that the jobs market is still in need of improvement to rebalance the dynamics between labor supply and labor demand. Thanks for watching the Main Street Macro. For more information on the week ahead and a deep dive into the latest employment numbers, please go to adpri.org.